Hello and welcome to Earnings Echo. We put together the most important information about Palantir Technologies. Today we are doing a deep dive into their Q1 2026 earnings report to answer one really critical question for you. Is Palantir's current $360 billion valuation actually grounded in fundamental reality? Or is the market pricing in a mathematically impossible scenario?
Right. So let's get straight into the hard data for Q1 2026. Total revenue hit $1.63 billion, which is a massive 85% year-over-year increase.
And the bottom line metrics were just as aggressive. GAAP earnings per share came in at 34 cents, so they clearly beat the consensus estimate of 28 cents by a solid 6 cents.
Exactly. And management didn't stop there. They bumped up their full year 2026 revenue guidance to a range of $7.65 to $7.66 billion.
Which is a huge raise. But looking at the market reaction, the analysis gets a bit complicated here. The company crushed expectations, but the stock's historically astronomical forward multiples have compressed to, well, a slightly more reasonable 86 times forward free cash flow.
Right. It's adjusting to reality, but nobody is calling 86 times cash flow cheap.
Not at all.
Yeah.
So where exactly is the operational drive for this beat coming from right now?
It is almost entirely domestic. U.S. commercial revenues skyrocketed 133% year-over-year to $595 million, and U.S. government revenue grew 84% to $687 million.
Wow. But the real story behind this beat has to be the margin profile, right?
Oh, absolutely. Their adjusted operating margin hit 60% this quarter. That pushes Palantir's Rule of 40 score to a staggering 145%.
Let's pause on that metric for a second because, 145% on the Rule of 40 almost sounds like broken math. How are they scaling revenue that aggressively without their operational costs just eating them alive?
You have to look at their efficiency data. Revenue per employee reached $1.5 million annualized. So they are expanding the top line without a proportional increase in headcount.
Which is incredibly rare. So the product is pulling the demand rather than them relying on, a massive outbound sales force.
Right. In fact, their sales team is actually smaller today than it was 2 years ago.
That operational leverage perfectly matches the highly aggressive, almost confident tone of the earnings call. CEO Alex Karp referred to their current growth as a phase shift. He actually used the word sublimation.
Sublimation, right. Like in physics, when a solid turns directly into a gas, just completely skipping the liquid phase.
Exactly. He is arguing Palantir is bypassing traditional sluggish enterprise sales cycles entirely.
And CTO Shyam Sankar pointed out exactly why that bypass is happening. He warned that the rapid deployment of AI creates what he called more slop and vulnerabilities for enterprises.
Which is such a great way to visualize the mechanism at play here. If foundational AI models are this wild, untamed river generating endless chaotic code, Palantir's Apollo platform basically acts as the hydroelectric dam.
Right. It manages and secures that AI slop into something a massive corporation can actually use safely without breaking compliance.
And that infrastructure play is exactly why the market is assigning such a high premium. But to quantify that premium, we really need to run a reverse DCF, right?
Yes, a reverse discounted cash flow model. Just to briefly explain this for you, a reverse DCF isn't an exact science. It is more of a mathematical reality check.
So instead of projecting the future to find a fair stock price, we take today's $360 billion market cap and calculate backward.
Exactly. We use it to reverse engineer exactly what growth rate the market is already pricing into the current stock price.
So what does the math say they actually have to deliver?
Well, to justify the current price, the market implies Palantir must sustain a 39.2% net income compound annual growth rate over the next 10 years.
That requires some serious critical pushback. Sustaining a 39.2% growth rate for a decade means Palantir has to generate $44.4 billion in net income by 2035.
Which is a level currently reserved for absolute giants like Apple, Microsoft, and Saudi Aramco.
Right. So while the operational leverage is brilliant, buying at all-time highs assumes they execute flawlessly for the next 10 years. Therefore, it remains a qualified buy on pullbacks, not something you blindly chase here.
Which brings us to the long-term investment echo you need to take away today. Palantir is solidifying its position as the critical N-of-1 infrastructure for actually deploying operational AI in the real world.
It definitely leaves you with a provocative thought to mull over. As AI token costs plummet and foundational model providers swap places every 6 months, will the ultimate long-term monopoly value reside entirely in the unglamorous software that secures and organizes this AI slop, rather than in the AI models themselves? And finally, The obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.